Hello everyone, how goes it? Welcome back to another episode of Dividend Compounders with Cheese. Let's talk about Whirlpool, ticker symbol WHR. If you are considering jumping in right now, it might be a good or a bad time as they are near their 52-week low. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. Whirlpool and its brands are in the business of selling household appliances, gadgets, tools, and whatever else you can use to cook, clean, or store food. In the US, you can't say laundry without Whirlpool, and I am not exaggerating. And on your screen, you're going to see all the different brands that belong to the Whirlpool portfolio. I personally frequent the Buy It For Life subreddit, and one of the things they always mention is darn tough socks, which I agree with. The reason why I prefer to buy something that might be a little expensive up front, but is of quality and is durable, is because it's going to last. And in that subreddit, KitchenAid is almost always mentioned when there is a conversation about kitchen tools like mixers, bowls, or even can openers. In my own personal home, my washer, dryer, fridge, and dishwasher are all Whirlpool. So it got me curious about the health of the company, and I started to look into it, and I decided to make this video because if you're curious like me, let's learn together. And it turns out right now they are going through it. And what I mean by that is like going through your first relationship breakup. They're going through a tough time. But eventually we all get through it, right? With time, maybe Whirlpool can rebound too. By the way, I just checked my oven stovetop, and guess what? That's also made by Whirlpool. Right now, I literally have to check my underwear to see if that too is made by Whirlpool. Anyways, this channel is focused on dividend compounders, so let's go ahead and check out their dividend over the years. By the way, do you recognize these brands? As you can see, pretty much in any region of the world, Whirlpool has a monopoly in the washing machine industry. Okay, Whirlpool, you paid $2.38 in 2013 as your dividend payment. You fast forward throughout the years, yes, they have been increasing it, and as of last year, they paid a dividend of $7 per share. I will absolutely respect the heck out of that if they can sustain it, and yes, that is a juicy dividend yield. Moving right along, let's go ahead and talk about their business model and if they have an economic advantage or a moat. How does Whirlpool make revenue? Personally, I think from a business standpoint, their operations is really easy to understand. Whirlpool is in the business of selling their home appliances that most people use day to day. They essentially have two types of avenues to accomplish this. Number one, from new homes. Essentially, they secure a contract with home builders for them to buy a shipping container's worth of washers and dryers to equip the new homes. And number two, through existing homes, from people looking to replace appliances that are no longer working properly, or if they just want to upgrade. In my neighborhood, every single one of our homes comes stocked with Whirlpool products. So when you move in, that's your fridge by default, your oven, your everything. So I can only imagine the scale of operations they have when considering the contracts around the world with other home builders and other neighborhoods. Because if you think about it, if you build 24 homes in a new neighborhood and each one of those homes are stocked with Whirlpool, that's good business. Whirlpool's washers and dryers are not cheap. Oh, and by the way, they also have a business segment dedicated to doing repairs and maintenance on their equipment and servicing out their warranty. So what is Whirlpool's economic moat or advantage? Well, I would say it is their brand, the reputation behind it, and the quality of their products. You know it's not going to be some cheap piece of crap on Amazon. Can we all please agree that sometimes brand does not matter? But in certain aspects of materialistic possessions in life, yes, it matters. I would much rather own a Toyota than a Ford. I would much rather have a Medtronic or an Edwards Life Sciences device in my body helping me stay alive than a no-name brand. And when it comes to washers and dryers, is it bad that I would rather have a brand that is known for its quality? And Whirlpool's second economic advantage is that they serve a market of over 170 different countries. So whether you are in Asia or North America, their washers are still being sold in the big box stores. So a pretty huge footprint of their influence. By the way, this business model is not a very sexy one like electric vehicles from Tesla, but it is a Western necessity that makes our life a little better. Up until a few years ago, I used to hand wash every single dish for my family. And now as my family is getting bigger and all of us are getting busier, I have now defaulted to utilizing the convenience of Whirlpool products, and it has made a huge world of difference. Because when I used to hand wash dishes, it would take me no less than 1 hour and 30 minutes almost every day to knock them out. And now it's just a matter of loading up the rack. I'm not the biggest fan of hand washing dishes, but I did use that time to listen to podcasts while I did it. And I used to watch videos like what you're seeing right now, like my kind of content, as I washed and scrubbed the pots and pans. So what are the upsides to Whirlpool? Well, number one, regardless if the new generation is going to be buying or renting, there still needs to be washing machines and dryers inside the building. Either a corporation can secure a contract with Whirlpool to buy like 50 of them, or the homeowner will buy a machine so they can have clean clothes or to bake stuff, or like in my case, to save time from scrubbing the dishes manually. So I would say that it's a consumer business that has a steady revenue source. The caveat is it's not going to be frequently, but maybe in intervals of 3 to 7 years for every consumer. If we are going to be honest with one another, it's not like a cell phone where you replace it every 2 to 3 years, right? You expect your washing machine to at least last 5 years, which by the way, I have been using my current cell phone for a little over 3 years now, and I have been eyeballing the new iPhone 15, but I have not pulled the trigger yet. Number two is that the company has been buying back shares at a very aggressive rate, and they have been supporting the dividend growth throughout the years. Moving right along, let's go ahead and talk about the downsides of Whirlpool, and there's a lot of them, but I will only share with you my top 3. Number one is that the revenue growth is slowing down and reversing back to pre-COVID territory. That's huge. Number two is that the free cash flow is decreasing, sales are declining, and all other business metrics for the most part are on the downtrend. And last but not least, there is increased competition from LG and Samsung for home good appliances. Historically, Whirlpool's rival has always been GE, but I think Whirlpool is far superior, or maybe that's just how I cope with the fact that my entire home is serviced by Whirlpool. Maybe GE is better, but I've only ever used Whirlpool products. Alrighty, so let's go ahead and move on to the next metric. Let's talk about their most recent earnings report. I just alluded to the financial health of Whirlpool. Let's just say there's thunderstorms ahead of this ship's voyage because of the fact that most of their metrics are down year over year. During the pandemic, everybody was doing home renovations and moving into new homes with the low interest rates and mortgages. However, now that everyone has bought a washing machine, a dryer, a dishwasher, and etc. in 2020 or 2021, now they are good to go for the next handful of years. As you can see, reflected year over year, everything is dropping. In the most recent earnings call, their CEO was very transparent about the housing boom slowdown and volatility. He even referred to it as a Dr. Jekyll and Mr. Hyde situation, but long term, he is somehow bullish. Whirlpool has a very interesting and questionable global strategy. Because of concerns of EBITDA profit margins internationally, they have decided to divest most of their business in Europe, the Middle East, and Africa to a Turkish appliance company called Arçelik, doing the same business as Whirlpool in the same industry. In lieu of owning 100% of the operations in this region, Whirlpool have agreed to 25% ownership of Arçelik, and Arçelik paid Whirlpool 20 million euros for this deal to unfold, and both of them had to jump through hoops and loops of the anti-monopoly laws that are in place in Europe. And Arçelik also paid 78.3 million euros for existing Whirlpool's operation plants based in Europe, and they have taken complete control of the Russian market. Whirlpool essentially packed up their bags and left Russia, just like Domino's Pizza did. Just take a look at their Asia market and performance. It is absolutely atrocious. So on a high level, I really want to question the executive leadership team. What is their strategy going forward? And then when we look at the Europe, Middle East, and Africa segment of their business, yes, that is also not doing too hot. But on the flip side, in Brazil and in Mexico, they are doing very well. And supply chain wise, by the way, is anyone struggling with their supply chain shortages anymore. Regardless, their inventory is back and it has been optimized. Their problem is the demand has decreased. So if you have no idea what I'm talking about, during the pandemic, with people being sick and unable to go to work or at the factories, the shipping ports being clogged, the global supply chain was an absolute wreck. And the headlines everywhere highlighted the chips shortage, and that's why we couldn't manufacture the cars properly, the computers, or any type of machine. Overall, regarding their most recent earnings report, the CEO just seemed really optimistic, and he was even making jokes the entire call. The fact that he was laughing off the bad results here and there reminds me of the meme, "Everything is fine." Maybe that's how the CEO really feels deep down inside. Because usually CEOs will give lip service to not panic investors. I will say this, the German CEO, he looked genuinely calm about the future of Whirlpool. And not only that, he seemed bullish about their upcoming R&D rollouts and other future plans. I truly wish I could see what he sees, because on paper and through their finances, it does not look good. And speaking of R&D and innovations, I think this right here will actually be useful in the everyday life. I don't need Wi-Fi to be attached to my fridge or my washing machine, but to have a third rack in order to load more dishes? Yeah, that's practical. Can somebody tell me why we are attaching Wi-Fi to the washing machines, to the dryers, to the microwaves? I don't like it. So I specialize and come from a supply chain background. And when I look at that, that just increases the probability of something breaking down and you having to pay to have it fixed. Can we stop attaching weird technology to our appliances? And before we move on to the next metric, I just want to mention that this is not a trend that is just happening in 2023. Whirlpool also reported double-digit losses last year, so this company is struggling right now. The next category that we are going to evaluate is the shares outstanding. We want to find out if the company is issuing more stocks and diluting the shareholders, or are they buying back shares? Buying back is a good thing because less shares outstanding means that each share that you own has quality over quantity. So back in 2013, there were 81 million shares outstanding, and since then, Whirlpool has been buying back aggressively, and now currently there are 55 million shares outstanding. So this is a good thing. So at least they're doing something right. More importantly, how has Whirlpool performed over the years? Well, if you had put $1,000 into Whirlpool back in December of 2013, it would now be worth $962 in November of 2023. This is not good, and this is taking into consideration with the dividends reinvested every quarter. This is really sad to see. What about the past 5 years? The performance for the past 5 years is no better. The total return is 12.28%. That is it. You essentially lost money if you invested into Whirlpool back in 2019. And the CAGR year over year is 0.89%. Not even 1%. Another red flag. If this was a dating show, this is where you tap the button and you say, "Sorry, but I just don't see us working out." But before we come to that conclusion, let's go ahead and do the valuation models to figure out the intrinsic value for Whirlpool. This is my most favorite part of the video. And then we are going to compare that price to what the Wall Street analysts believe the price target should be. So the first valuation model is going to be the multiples valuation. Essentially, we are going to be looking at companies in the same industry as Whirlpool to figure out how the market values them and then to derive an intrinsic value for Whirlpool based on that valuation. So the median PE ratio for these companies, well, it's 16.04. So taking that into consideration with their earnings per share, this spits out an intrinsic value of Whirlpool, $315.18. Moving right along, we are going to be looking at the discounted cash flow analysis model. Essentially, we are going to reach an intrinsic value for Whirlpool based on its free cash flow growth. And when you look at 2017 all the way to last year, there has been a positive trend. However, as we have learned earlier, 2022 is the start of the downfall of Whirlpool, and so their free cash flow decreased by 50% year over year from 2021 to 2022. But prior to that, they were on a healthy trend. So taking that into consideration, this spits out an average growth rate for the free cash flow of 15.34%. However, we are going to divide that by 2 because we want to be conservative and say 7%. So we're going to plug that into the formula and look at some other balance sheet numbers, which is going to spit out a discounted cash flow price of $228.75 for Whirlpool. By the way, these valuations seem really high, so let's look at their past 5 years. So it looks like in May of 2020, 2021, Whirlpool did trade for about $252 per share, and now they are trading at $110, which is essentially the same price they were back in 2013. But I digress. I don't want to drive this bus off the cliff. Next, we are going to look at the dividend discount model. Essentially, we are going to reach an intrinsic value for Whirlpool based on the future growth of their dividends. So year over year, Whirlpool has been growing their dividend. And even though Whirlpool is going through a financial turmoil, they increased their dividend by 25% from last year to now. So taking the historical data into consideration, this gives us an average dividend growth rate of 11.38% year over year. This sounds way too positive and optimistic. So I am going to be conservative and play it safe and plug in 4.5% instead into the formula. This gives us an intrinsic value for the DDM model, $209 for Whirlpool. Next, we are going to move on to the Benny Graham's valuation model. Essentially, the Graham's valuation is going to tell us the intrinsic price based on its growth rate projection and the current AAA corporate bonds yield rate. So taking all of that into consideration, the Graham value for Whirlpool is $142.54. You never let me down, Grammy. You never let me down. All right, my friend, we have made it to the conclusion. Let's figure out what the intrinsic value for Whirlpool is. Drum roll, please, Jimmy. Ba 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 ba. The intrinsic value for Whirlpool, $223.87. Well, let's see what the Wall Street analysts have to say. Wall Street says that Whirlpool is worth $137.80 with a low forecast of $92 and a high forecast of $160. So it does look like there's a huge disparity between Wall Street and our numbers. So after seeing and hearing everything, you're still interested in Whirlpool. I don't know why you would be, but if you are, let's figure out the acceptable buy price. Currently, it's $110. With a 10% margin of safety baked in, then your acceptable buy price would be $201.48 per share. But let's figure out what is the discount that you get if you buy it at its current price. If you were to buy into Whirlpool right now at its current trading price, essentially you get a 51% margin of safety baked in. And I just want to throw this out there. Warren Buffett said it's much better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. So I would encourage you, if you are infatuated with the idea of seeing Whirlpool as an undervalued company, please do your own due diligence and research. As for my opinion, what do I feel about Whirlpool? Well, even though the dividend yield is juicy, I think this hypothetical backtest graphic right here just explains everything. Whirlpool's total return for the past 5 years in what was one of the biggest bull market runs being 12%. Oh, that just hurts. That pains me. So my opinion is this. As a company and its performance, I think it's a disgusting dividend stock. However, if we are only evaluating Whirlpool based on their dividend and their dividend history and that growth rate and that yield, and the fact that since 1995 they have been increasing it year over year, that alone makes it a very delicious dividend stock. However, and just like with any other big purchase that we make in life, whether it's a car or a home, you can't just look at one metric, such as the neighborhood or the size of the tires. You have to look at the whole picture. And when we look at the whole picture, I just feel like Whirlpool has a lot of speed bumps coming their way. Anyways, I hope I didn't hurt anybody's feelings. Like, if you are truly in love with Whirlpool, I'm sorry. If you made it to this point in the video, please do me a solid and subscribe. I would genuinely appreciate it a lot because it would help the channel out. Dividend Compounders with Cheese signing out. I'll talk to you next time. Stay safe.